You ever wonder how a kid who bought his first stock at 11 years old became worth over $100 billion by doing the exact opposite of what Wall Street tells you to do? Here's how Warren Buffett actually built Berkshire Hathaway. In 1965, New Bedford, Massachusetts, Warren Buffett is sitting in a textile mill that's literally falling apart. The Berkshire Hathaway factory floor is dusty, the machinery is outdated, and the business is dying. He's just spent $14 million buying control of this failing company. His partners think he's lost his mind. His mentor Ben Graham would tell him this violates every principle he ever taught, and Buffett knows, he absolutely knows, this is a terrible business. Textile industry is moving overseas. The margins are razor thin. This company has been declining for decades. But here's the thing, Buffett isn't buying it for the textiles. He's buying it because the CEO, Seabury Stanton, tried to cheat him out of 1/8 of a point per share. And that petty decision, that ego-driven moment of revenge, is about to accidentally create one of the most valuable companies in human history. I'm Alex Morgan, this is Behind the Billion, and today we're breaking down how Warren Buffett built Berkshire Hathaway into a $500 billion empire. Now, I've spent the last week reading everything I could find about Buffett, his shareholder letters going back to 1965, The Snowball by Alice Schroeder, Roger Lowenstein's biography, every interview Charlie Munger ever gave, and here's what's wild, the investment strategy that made Buffett the richest investor in history. He admits it started as a mistake, a costly, ego-driven mistake that he turned into something brilliant. So let me take you back to the beginning, because to understand Berkshire Hathaway, you have to understand the kid who built it. Warren Buffett was born in Omaha, Nebraska in 1930, middle of the Depression. His dad was a stockbroker who eventually became a congressman. And young Warren, he was obsessed with numbers from the start. At 6 years old, he's buying 6 packs of Coca-Cola for 25 cents and selling individual bottles for a nickel each. 5-cent profit per bottle, 30 cents total. He's calculating margins before he knows what margins are. At 11, he buys his first stock. City Service preferred shares, 3 shares at $38 each. He's using his entire savings. The stock drops to $27 and Warren's terrified. Then it climbs back to $40 and he sells, takes his profit, feels smart, then watches the stock shoot up to $200. And that moment, that taught him something crucial: don't sell too early. Patience pays. By the time he's a teenager, Warren's running 5 or 6 businesses. He's got paper routes, he's selling golf balls he fishes out of ponds. He's buying a pinball machine, putting it in a barber shop and splitting the profits with the barber. Then he buys another machine, then another. By high school, he's making more money than his teachers. He files his first tax return at 13 years old and deducts his bicycle as a business expense. The IRS approves it. Now here's where it gets interesting. Warren applies to Harvard Business School, gets rejected. He's devastated. But then he finds out that Ben Graham, Ben Graham, who wrote The Intelligent Investor, teaches at Columbia. So Buffett applies to Columbia just to study under Graham, gets in, and this is the moment that shapes everything. Ben Graham created value investing. The idea is simple: find companies trading for less than they're actually worth. Graham called it buying a dollar for 50 cents. He taught his students to ignore market emotions and focus on fundamentals. Look at the balance sheet. Calculate intrinsic value. Buy when the market price is significantly below that value, then wait. Buffett absorbed this like a sponge. He graduates in 1951, top of his class. Offers to work for Graham's investment firm for free. Graham says no, so Buffett goes back to Omaha and starts working for his dad's brokerage. But he's constantly writing to Graham, sending him investment ideas, staying on his radar. Finally, in 1954, Graham hires him. Buffett moves to New York, works at Graham Newman Corporation, and learns the craft. But here's what most people don't realize. Buffett saw the limitations of Graham's approach early. Graham was all about cigar butts, companies so cheap that even if they had one puff left, you'd make money. Buy them, extract the value, move on. Buffett started thinking, what if instead of buying terrible companies at great prices, you bought great companies at good prices? In 1956, Graham retires and closes the firm. Buffett's 25 years old. He moved back to Omaha and starts his own investment partnership with $100,000 from 7 investors and $5,000 of his own money. That's it. And he makes his investors a promise: I'll charge no management fee, only 25% of profits above 6% annually. If I don't beat 6%, I make nothing. The Buffett partnership, as it's called, crushes it. We're talking 30%, 40%, sometimes 50% annual returns while the market's doing 10%. By 1962, he's managing millions. By 1965, he's managing over $20 million, and his investors, they're getting rich. Now, during this period, Buffett starts buying shares of a textile company called Berkshire Hathaway. This company has history. It was formed in 1955 when Berkshire Fine Spinning and Hathaway Manufacturing merged. But by the 1960s, textiles are dying in New England. Labor's expensive. Foreign competition is brutal. The company keeps closing mills, liquidating assets, and buying back shares with the proceeds. And Buffett sees an opportunity. Every time Berkshire closes a mill, they buy back shares. The stock price goes up temporarily. So Buffett buys shares, waits for the next closure, sells back to the company at a higher price, and pockets the difference. It's a pure Graham play, cigar butt investing. Get in, get out, make money. But then in 1964, something happens. Seabury Stanton, the CEO, offers to buy back Buffett's shares. They agree on a price verbally. Buffett says yes, but when the written offer arrives, it's 1/8 of a point lower than what they agreed. 1/8 of a point, we're talking about maybe $25,000 on Buffett's position. Now, Buffett's a rational guy, right? He should just sell, take the money, move on, but he doesn't. He's furious. He feels cheated. So instead of selling, he starts buying more shares, aggressively. He's buying up everything he can find. And in May 1965, he takes control of the company, $14 million, and the first thing he does, he fires Seabury Stanton. Let me repeat that. Buffett spent $14 million to fire a guy who tried to cheat him out of $25,000. It's the most expensive ego trip in investment history, and Buffett will later call this one of the biggest mistakes he ever made. Because here's the reality, Berkshire Hathaway is a terrible business. The textile industry is in permanent decline. Foreign competition is destroying American mills. The machinery is old. The unions are strong, so labor costs are high. The margins are tiny. This is not a business that's going to make anyone rich. Buffett now owns it, so what does he do? He tries to run it. He puts in a new CEO, Ken Chase, who's been with the company for years. Smart guy, knows textiles, and they try everything to make it work. They modernize equipment, they focus on higher margin products, they cut costs, and for a few years they actually stabilize the business. But stabilize is not the same as thrive. The best they can do is break even. Meanwhile, Buffett's investment partnership is still running. He's still buying stocks, still generating incredible returns, and he starts to have an idea. What if he uses Berkshire Hathaway, this public company he controls, as a vehicle for buying other businesses? What if the textile mill isn't the point? What if it's just the shell? So in 1967, Buffett makes his first acquisition through Berkshire, National Indemnity, an insurance company. He pays $8.6 million, and this is the move that changes everything. Here's why insurance is brilliant. Insurance companies collect premiums up front, then pay claims later, sometimes years later. In the meantime, that money called float just sits there, and you can invest it. So you're essentially getting free money to invest. As long as your underwriting is disciplined and you don't pay out more in claims than you collect in premiums, you've got this permanent pile of capital to deploy. National Indemnity gives Buffett float. Not a lot at first, maybe $20 million, but it's a start, and Buffett's a genius at deploying capital. He starts using that float to buy stocks. He buys shares of American Express during the salad oil scandal when everyone's panicking. He buys Disney. He buys banks, newspapers, retailers, all through Berkshire. Now in 1969, Buffett does something shocking. He shuts down his investment partnership. He's at the peak of his success. His returns are legendary, but he tells his investors, the market's overvalued. I can't find good opportunities. I don't want to compound your money at mediocre rates, so he's liquidating. Most of his partners are devastated, but Buffett gives them two options. They can take cash or they can roll their money into Berkshire Hathaway stock. A lot of them take the stock, and that decision makes them unbelievably wealthy. Because now Buffett's focus is 100% on Berkshire. He's got the insurance float. He's got the textile business, which is still barely breaking even but generating some cash. And he's got total control. No outside investors to answer to, no quarterly redemptions, no pressure to beat benchmarks. He can invest with a 10-year, 20-year, 30-year horizon. In 1970, he buys a stake in a small Omaha newspaper, The Sun. Then he buys more newspapers. In 1972, he buys See's Candies for $25 million, and this purchase teaches him something crucial. See's is making about $2 million in profit, so he's paying about 12.5 times earnings. By Graham's standards, that's expensive. Graham would say walk away, but Charlie Munger, who's become Buffett's partner and closest advisor by this point, convinces him to look deeper. See's isn't just a candy company, it's a brand. Every Christmas, people in California buy See's Candies. They've been doing it for decades. It's a tradition. And that brand loyalty means See's can raise prices without losing customers. Buffett buys it, and over the next 30 years, See's generates over $1.5 billion in cash while requiring almost no additional capital investment. That's the power of a great business. And this is when Buffett's philosophy shifts. He's moving away from cigar butts. He's moving toward quality. It's a principle he'll later articulate in his shareholder letters. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And this shift from Graham's pure value approach to what Buffett calls business quality investing is what separates him from every other value investor of his era. Throughout the 1970s, Buffett's buying newspapers, insurance companies, banks, retailers. He buys Buffalo News. He buys more insurance companies to add to his float. By the end of the decade, Berkshire's float is over $100 million, and Buffett's using every dollar of it to buy stocks and businesses. Then comes the 1980s, and this is when Berkshire really explodes. In 1983, Buffett buys a majority stake in Nebraska Furniture Mart. The founder, Rose Blunkin, Mrs. B as everyone calls her, is in her 90s, still running the place. No lawyers, no due diligence. Buffett just hands her a check and they shake hands. The business does $100 million in sales and has incredible margins because Mrs. B runs it so efficiently. In 1985, Buffett finally shuts down the textile mills. It's been 20 years, he's tried everything. But textiles are a dying industry and he's done losing money on them. So he closes the mills, lays off the workers, and fully transforms Berkshire into an insurance and investment conglomerate. The name stays Berkshire Hathaway, but the textile business is gone. And here's where I want to pause for a second. Because Buffett later says that if he hadn't bought Berkshire out of spite, if he just invested that $14 million directly into insurance companies and stocks, Berkshire would be worth twice as much today. Maybe $200 billion more. That's how much that ego-driven decision cost him. But here's the paradox. Without buying Berkshire, would he have built the same company? Would he have had the vehicle to make all those acquisitions? Would he have created the culture that made Berkshire so successful? Maybe not. Maybe that mistake was necessary. Okay, so by the mid-1980s, Berkshire's structure is clear. It's an insurance company that generates float. That float gets invested in stocks and wholly owned businesses. The stocks pay dividends. The businesses generate cash. All that cash flows back to Omaha, and Buffett reallocates it to wherever he sees the best opportunities. It's a capital allocation machine. Buffett's investments during this period are legendary. He buys a huge stake in Coca-Cola in 1988. Everyone thinks he's crazy because Coke's stock has already run up. But Buffett sees a global brand with pricing power that's barely scratched the surface internationally. He invests over $1 billion. Today, that stake is worth over $20 billion. He buys Wells Fargo in 1990 during the savings and loan crisis when everyone thinks banks are going to collapse. He buys American Express again. He buys Gillette. These aren't cigar butts. These are the best businesses in the world bought at reasonable prices during moments of fear. And the float keeps growing. By 1995, Berkshire's insurance float is over $3 billion. By 2000, it's $28 billion. Today, it's over $160 billion. That's $160 billion of capital that Buffett can invest, and as long as his insurance companies break even on underwriting, it's essentially free money. But it's not just the float, it's the culture Buffett builds. He gives his managers total autonomy. If you run a business that Berkshire buys, Buffett leaves you alone. He doesn't impose corporate bureaucracy. He doesn't consolidate operations. He doesn't interfere. He just lets you run your business the way you've always run it, and in exchange, you send the cash to Omaha. This culture attracts a certain kind of entrepreneur. People who have built incredible businesses and want to sell, but only if they can keep running them. People like the Rooney family who owned H. Brown Shoe Company, or Irv Blunkin, Mrs. B's grandson who ran Nebraska Furniture Mart. They sell to Berkshire because they trust Buffett, and that trust creates this flywheel where more great businesses want to be part of Berkshire. Shareholder letters are a huge part of this. Every year, Buffett writes a letter to Berkshire shareholders, and these aren't your typical corporate reports full of jargon and spin. They're honest, funny, educational. Buffett admits mistakes. He explains his thinking. He uses analogies and stories. He talks about the businesses in plain English, and investors love it. Reading those letters, you get a masterclass in capital allocation, business quality, and long-term thinking. Buffett explains why he loves businesses with pricing power, why he avoids businesses that require constant capital investment, why he focuses on companies with durable competitive advantages, what he calls moats, why he only invests in industries he understands, why he doesn't care about quarterly earnings or stock price volatility. And over decades, this philosophy compounds. Berkshire's book value per share grows at 20% annually from 1965 to 2020, 20% for 55 years. The S&P 500 does about 10% over the same period. That difference, 10% versus 20%, turns a $100 investment in 1965 into $3,000 in the S&P or $2.8 million in Berkshire. That's the power of compounding over time. Now let's talk about Charlie Munger, because you can't understand Berkshire without understanding Charlie. Munger's a lawyer from Omaha, about 7 years older than Buffett. They meet in 1959 and immediately hit it off. Both are voracious readers, both think independently, both love business and investing, and Charlie pushes Buffett to evolve beyond Graham's cigar butt approach. Charlie's famous line is, "It's better to buy a wonderful business at a fair price than a fair business at a wonderful price." And he's constantly challenging Buffett to think bigger. Stop buying mediocre companies just because they're cheap. Start buying great companies even if you have to pay up a little. This partnership, Buffett and Munger, becomes one of the great intellectual partnerships in business history. They think out loud together, they disagree, they challenge each other, and out of that friction comes better decisions. Munger becomes vice chairman of Berkshire in 1978, and they run the company together for the next 45 years. 1990s and 2000s are when Berkshire becomes truly massive. Buffett starts buying whole companies instead of just stocks. In 1998, he buys General Ray, a massive reinsurance company, for $22 billion. It's Berkshire's biggest acquisition ever at that point. General Ray brings huge float but also huge problems. The underwriting is sloppy. The derivatives book is a mess. It takes years to fix. But Buffett persists. He installs new management. He cleans up the balance sheet. And eventually, General Ray becomes a solid contributor to Berkshire's insurance operations. In 2000, he buys Mid-American Energy, a utility company. This is different for Buffett. Utilities are regulated, low-return businesses, but they're stable, they generate cash, and they're useful for deploying capital in renewable energy projects. Today, Berkshire's energy portfolio includes wind farms, solar installations, and natural gas pipelines. In 2003, he buys Clayton Homes, a manufactured housing company. In 2006, he buys a huge chunk of Iskar, an Israeli cutting tool manufacturer. In 2009, during the financial crisis, he invests $5 billion in Goldman Sachs and another $3 billion in GE, both at preferential terms. These crisis investments are classic Buffett. Everyone else is panicking. He's deploying capital. In 2010, he buys Burlington Northern Santa Fe, a railroad company, for $34 billion. It's Berkshire's largest acquisition ever, and Buffett's bet is simple: railroads are essential infrastructure. They move coal, oil, grain, consumer goods. They can't be disrupted easily. They require enormous capital to build, so competition is limited. It's a toll bridge on the economy. And then in 2016, he makes a massive investment in Apple. This surprises everyone because Buffett has always avoided tech. He doesn't understand it, he says. It changes too fast, but Apple's different. It's not a tech company in Buffett's mind. It's a consumer products company with the strongest brand loyalty in the world. People don't just use iPhone, they're emotionally attached to them, and that brand loyalty gives Apple pricing power. Buffett starts buying in early 2016. By 2018, Berkshire owns over $50 billion of Apple stock. Today, that position is worth over $150 billion. It's Berkshire's largest holding by far, and it's a perfect example of Buffett's evolution. He started with cigar butts in the 1950s. He moved to quality businesses in the 1970s. And by the 2010s, he's buying the best companies in the world, even if they're in industries he once avoided. Now let's talk about how Buffett actually picks investments. Because the principles are simple, but executing them is hard. Buffett looks for businesses with a few key characteristics. First, he wants a moat, a durable competitive advantage that protects the business from competitors. This could be a brand like Coca-Cola or Apple. It could be a cost advantage like Geico's direct distribution model. It could be a network effect like American Express. It could be switching costs like when companies use Salesforce and don't want to migrate their data. Whatever it is, the moat means the business can maintain high returns on capital for decades. Second, he wants management he trusts. Buffett doesn't do hostile takeovers. He doesn't buy companies to flip them. He's looking for managers who are competent, honest, and think like owners. He wants people who love the business, not people who are just there for a paycheck. And once he invests, he leaves them alone. Third, he wants businesses he understands. Buffett famously avoided tech for decades because he didn't understand how to value it. He doesn't invest in biotech or complex financial derivatives. He sticks to businesses where he can reasonably predict what they'll look like in 10 years. If he can't, he passes. Fourth, he wants a fair price. Not necessarily a cheap price, but a fair one. Buffett's willing to pay up for quality, but he's not going to overpay. He calculates intrinsic value, the present value of all future cash flows, and compares it to the market price. If there's a meaningful gap, he invests. If not, he waits. And here's the thing, Buffett's willing to wait. He's not in a hurry. Berkshire holds over $100 billion in cash most of the time because Buffett would rather sit on cash than make a mediocre investment. He's patient. And that patience is a huge competitive advantage because most investors are impatient. The other key to Berkshire's success is how Buffett thinks about risk. Most investors think risk is volatility, how much a stock price bounces around. Buffett thinks that's nonsense. Risk to him is the permanent loss of capital. It's buying a business that deteriorates over time. It's overpaying for an asset. It's investing in something you don't understand. So Buffett's version of risk management is simple. Don't do stupid things. Don't use leverage unless it's the stable, long-duration float from insurance. Don't invest in industries you don't understand. Don't overpay. Don't follow trends. Don't panic during downturns. Just focus on finding great businesses at fair prices and holding them forever. Forever is not an exaggeration. Buffett's average holding period is measured in decades. He's owned Coca-Cola since 1988. He's owned American Express since the 1960s. He's owned Geico since 1976. This isn't trading. This is ownership. And because he's not selling, he's not paying capital gains taxes, which means his money compounds faster. There's a great example of this in his shareholder letters. Buffett calculates that if you buy a stock and hold it for 30 years, earning 10% annually, you end up with about $17.45 for every dollar invested after taxes. But if you trade frequently and pay taxes every year, you end up with only about $13.50. That difference, $17.45 versus $13.50, is entirely due to deferring taxes by not selling. It's a massive advantage. Now I want to talk about succession because this is a huge question for Berkshire. Buffett's 94 years old. Charlie Munger passed away in 2023 at age 99. So who's going to run this company when Buffett's gone? Buffett's been transparent about this. The CEO role will be split. Greg Abel, who runs Berkshire's non-insurance operations, will become CEO. Todd Combs and Ted Weschler, who have been managing parts of Berkshire's investment portfolio for years, will continue as investment managers. And Ajit Jain, who runs the insurance operations, will keep doing what he's doing. But here's the reality. No one's going to replicate Buffett. His track record is unrepeatable. His reputation is irreplaceable. The question isn't whether Berkshire will do as well without Buffett. It won't. The question is whether it can continue to be a well-run, shareholder-friendly company. And based on the structure Buffett's built, the culture he's instilled, and the people he's put in place, I think the answer is yes. But why does Berkshire matter today? Why should we care about a 94-year-old investor from Omaha running a conglomerate that most people think of as old-fashioned? Because the principles Buffett built Berkshire on are timeless. Focus on quality, be patient, think long-term, don't follow the crowd, don't try to get rich quick, just compound steadily over decades. In a world of high-frequency trading, meme stocks, SPACs, crypto hype, and quarterly earnings obsession, Berkshire is a throwback. It's a reminder that the boring approach works. Buy good businesses, hold them forever, let them compound, that's it. Look at the results. From 1965 to 2023, Berkshire stock has returned over 20% annually. That's roughly double the S&P 500 over 58 years. That kind of outperformance sustained for that long is almost impossible, and it was done with transparent, shareholder-friendly practices. No stock options for executives, no quarterly guidance, no financial engineering, just capital allocation. Buffett's also been one of the most transparent CEOs in history. His annual letters are free, online, and read by millions. He doesn't hide behind PR teams. He admits mistakes openly. In the 2008 letter, he wrote about his investment in ConocoPhillips. "I bought a lot of Conoco at around $80 per share. The price went to $30. It was a major mistake. No spin, no blame, just honesty." And he's used his platform to educate. He's taught millions of people about investing, about business, about rationality. His letters have been compiled into books. Business schools teach them. Investors quote them. He's made value investing accessible. Buffett's not perfect. He's made plenty of mistakes. Buying Berkshire Hathaway itself was a mistake, as he's admitted. His investment in Dexter Shoe Company, which he bought for $434 million in Berkshire stock in 1993, turned out to be worthless when Chinese competition destroyed the industry. He's overpaid for companies. He's missed opportunities. He didn't invest in Google or Amazon early, even though he had the chance. But the key is this: Buffett's mistakes have been errors of omission, not commission. He's missed opportunities, but he hasn't blown up. He hasn't taken existential risks. He hasn't bet the company. And over a 60-year career, avoiding catastrophic mistakes is more important than hitting every home run. There's also criticism of Berkshire's structure. Some people say conglomerates are inefficient, that breaking up Berkshire would unlock value. But Buffett's argument is that Berkshire's structure is its advantage. The insurance float gives him permanent capital. The wholly owned businesses generate steady cash. The stock portfolio provides liquidity, and he can move capital between all of them based on where he sees the best opportunities. No single business company has that flexibility. Another criticism is that Berkshire is getting too big to outperform, and there's truth to this. When you're managing $300 billion in stocks and $600 billion in total assets, you can't just buy small companies anymore. You need elephants, and elephants are rare. Buffett's openly said that Berkshire's size is an anchor to performance. But even with that anchor, Berkshire is still outperforming most funds and managers. Let me also talk about Buffett's lifestyle, because it's part of the story. This guy's worth over $100 billion, and he still lives in the same house in Omaha he bought in 1958 for $31,500. He drives his own car. He eats breakfast at McDonald's. His idea of luxury is a cherry Coke. He doesn't own a yacht. He doesn't collect art. He doesn't fly private jets. Well, actually, he does now because Berkshire owns NetJets, but for decades he flew commercial. His frugality isn't a gimmick, it's who he is. Buffett genuinely doesn't care about material things. What he cares about is the game, the intellectual challenge of finding great businesses, deploying capital, and watching it compound. He said multiple times that he tap dances to work. At 94, he's still reading annual reports, still taking calls, still analyzing businesses, because he loves it. And this connects to something deeper about Buffett's philosophy. He's talked a lot about the inner scorecard versus the outer scorecard. Most people care about the outer scorecard, what others think of them, how they're perceived, their status. Buffett cares about the inner scorecard, whether he's living according to his own values, whether he's doing what he thinks is right, whether he's being honest with himself. This inner scorecard philosophy shows up in how he invests. He doesn't care if everyone thinks he's crazy for buying stocks during a crash. He doesn't care if people mock him for missing the tech boom. He's not trying to impress anyone. He's just trying to make good decisions based on his own analysis. Now let's connect this to today. What can we learn from Buffett's approach that's relevant right now? First, patience is underrated. In a world where people expect instant results, where startups are supposed to go from zero to unicorn in 5 years, where investors flip stocks in seconds, Buffett's reminder is, good things take time. Compounding requires decades. You can't rush it. Second, simplicity beats complexity. Buffett's investment strategy isn't complicated. It's not algorithmic. It's not quantitative. It's just find good businesses, pay fair prices, hold forever. That's it. And yet, it's beaten almost every complex hedge fund strategy ever devised. Third, know what you don't know. Buffett's missed some of the biggest tech winners in history because he didn't understand them, and he's fine with that. He'd rather miss opportunities than invest in things he doesn't understand. That discipline, being comfortable saying, I don't know, and passing, is incredibly valuable. Fourth, use fear as opportunity. Buffett's best investments have come during crises. The 1973-74 crash, the 1987 crash, the 2008 financial crisis. The 2020 COVID crash, when everyone's panicking, he's buying. His famous line, be fearful when others are greedy and greedy when others are fearful. Fifth, reputation matters. Buffett's built a reputation for fairness, honesty, and rationality over 70 years, and that reputation has tangible value. People want to sell their companies to Berkshire because they trust him. Banks call him during crises because they trust him. Investors stick with Berkshire through downturns because they trust him. You can't fake that. You build it over decades. Sixth, culture compounds. Berkshire's culture, decentralized, trust-based, low bureaucracy, long-term focused, is as important as its capital. That culture attracts great managers, great businesses, and great opportunities. Culture isn't just touchy-feely HR stuff, it's a competitive advantage. Finally, think like an owner. Buffett doesn't think of stocks as ticker symbols or trading vehicles. He thinks of them as fractional ownership in real businesses. When he buys Coca-Cola stock, he's not betting on the stock price. He's buying a piece of a business that sells 1 billion drinks per day. That mindset shift from speculator to owner changes everything. Let me bring this full circle. Warren Buffett bought Berkshire Hathaway in 1965 out of spite. It was a failing textile company with no future. It was a mistake. But over the next 60 years, he turned that mistake into a $500 billion empire by doing a few things consistently: allocating capital intelligently, buying quality businesses, being patient, and compounding over decades. The lesson isn't that you should buy failing companies. The lesson is that what you do with your mistakes matters. Buffett could have liquidated Berkshire, taken his loss, and moved on. Instead, he turned it into a vehicle for something much bigger. He adapted. He learned. He evolved. And that evolution, from Graham's cigar butts to Munger's quality businesses to eventually buying the best companies in the world, shows intellectual humility. Buffett didn't stick rigidly to what he learned in business school. He updated his thinking as he gained experience. He admitted when he was wrong. He learned from mistakes. That's rare. Most people, especially successful people, get stuck in their ways. They find something that works and just repeat it forever. Buffett kept evolving. He's 94 years old and he's still learning, still reading, still thinking. So that's the story of how Warren Buffett built Berkshire Hathaway. It started with a mistake. It was built on principles of value, quality, patience, and compounding. It grew through disciplined capital allocation and long-term thinking, and it became one of the most successful companies in history. Was it genius or luck? Probably both, but what's undeniable is the framework, the principles, the discipline, and those things, they're replicable. You might not match Buffett's returns, nobody will. But you can apply his thinking to your own decisions, your own investments, your own life. Focus on quality, be patient, think long-term, let things compound. That's timeless. So that's the deep dive on how Warren Buffett built Berkshire Hathaway from a failing textile mill into a $500 billion empire. If this kind of research and storytelling is valuable to you, hit that subscribe button. I release new episodes every single day, diving deep into how these companies were actually built. I'm Alex Morgan. Thanks for listening.